Good morning, everyone. Shall we start the session? Hope everyone has joined. Welcome you all for the session 2, Corporate Finance and Risk Management session. First, before starting the session, I would like to introduce myself. I'm Nishant Adhikari. I don't know whether you will know about myself, and I'm doing this session over last, I can remember 3-4 years. I'm doing this session for this SL5 case study students. Today, I wanted to contribute you to get an idea about what are the important concepts in financial management. And while we're having our discussion, we will see some implication in the pre-scene as well. And then how you are going to relate those theory areas with practical application. You have to get an idea. This whole exercise is to give a brief idea or refresh the things you have already learned. Before starting the session, I think you have already gone through the pre-scene with the previous panelist in the previous session. Before moving into the session, first I would like to give a brief introduction about the syllabus content or what are the areas which will be tested. Then you can get an idea about the composition. First, now you have already completed 20% of your journey. That means 20% of the marks you have already completed. That is for the assignment you have already completed. That's why you are moving to the final examination. Then you have to score 40 out of 80 on the remaining paper which you need to write in the upcoming exam. That are such 80 marks being allocated into 4 areas. First area is corporate finance, financial management, 20% weightage given. That means out of 80, 20 marks allocated to corporate finance and risk management. Then 5% allocated to governance, ethics, and assurance. That aspect, in when we are analyzing the pre-scene, any governance aspect, ethical practices which you need to highlight, that can be tested. It has been given 5 marks. Then taxation, it has been allocated 10% or 10 marks. Then altogether 35 now. Balance 45, where it goes? Balance 45 goes to business strategy and corporate strategy. That means strategic management. That is the significant, more than 50%, more than 50% of the syllabus content or weight is given for strategic management. Right, the things you have learned in SB strategic leadership and the previous study, sometimes you might have learned in strategic management, will help you to go through that because that is the high weighted area. Those are the sections or areas which you need to look at. There, because some student might ask, there are some areas which we need to look at about the financial reporting, but it is not required. This is a area which we need to submit a business report, or sometime we have to write a memo based on this kind of a business proposal evaluation, right? Therefore, all aspect which I have told will be tested, can be tested, and there's no implication. Sometimes you might ask financial reporting, there's no implication of financial reporting, right? With having that idea, first I will move to my presentation, or after the presentation you can raise any question if you have. First, I would like to highlight this content, this area which we have 2 sections in financial management. The most important section is financial feasibility and funding. With the given situation, you might given situation to evaluate the options like different project appraisal techniques or project evaluation techniques you have to use to evaluate financial feasibility. That means it is a long-term decision making. You have to evaluate the options available, and the next step is to, once you have recommended this proposal, this project should have been undertaken, then you have to recommend what sort of financing arrangement as well. Therefore, by looking at these conditions, you have to recommend suitable funding method for the recommended acquisition, no merger or whatever the option given. right? You might have to evaluate whether it is financially feasible or not. Simply while you are reading these two, the requirement, the syllabus area, you should get an idea what are the areas they are expecting. I can remember in 2017, they have tested, you have to evaluate payback period and you have to comment whether you should undertake or not. And thereafter, you have recommend what is the suitable financing strategy. At that time, I can remember the company was 100% equity. If they wanted to expand, what sort of financing strategy should be recommended based on the capital structure of the company, and you have to consider market aspect. Guys, I am this is kind of summarizing the things because you have to work little hard and you have to do more practice questions and practice because most of the information relevant to the financial management will be visible in the unseen material, right? Therefore, we have to practice more and more. Then propose best possible funding strategy. That means based on the current capital market, you have to evaluate. If we think about previous batch or one batch before the previous batch, if you look at about the market condition, what at that time market liquidity was not there, right? Therefore, at that time, your cost of capital rate, that means borrowing rate, went up beyond 20-30%. Under such situation, you can't recommend by looking when you're going to, even though you are in 100% equity, you can't say that better to go with borrowings or debt financing because market condition is not favorable at that time. Therefore, when you are making a decision, when you're going to make a recommendation about the financing strategy, you have to see the outset, what market says and what is the market condition. Based on that, you have to give your recommendation. Right. Sometimes it might be when you are recommending the financing strategy, it might be equity, it might be debt. It depends on the market condition as well and the organizational capital structure as well. Sometimes you can recommend combination of both. Right. If you are engaging in import-export or oriented activities, you have to look at about other activities like exchange rate risk. When it come to the case scenario, you can see when we are running a hospital, we have to import some material, import some medicines. Then you can look at what kind of exchange rate we might have to face and some operational risk also there. Right. Those are first section we have look at about financial feasibility and funding. The second section you have look at about risk management. What kind of policy is required to manage the risk? That is very important. You have to identify risk management framework, you have to draft risk management policies if it is not being developed or if they are not practicing over it. Therefore, while looking at the scenario, you might feel it is a small thing, but it is not. This is a surface. In the risk management framework, you might have developed based on the, while analyzing the pre-scene, you might have to identify what kind of risk associate with the business and how to develop risk management framework, right? Therefore, these are the areas which will be covered under financial management and financial and risk management aspect, right? Okay. Okay, a very important topic is capital budgeting because when the requirement in the syllabus area, when you're looking at, it says about evaluation of feasible option. When you're going to evaluate possible option or feasible solution, simply it required to do the capital budgeting, project appraisal. That means you might require to do some long-term investment. When you have to do some long-term investment, what will happen? Because it will generate return over the period. You need to assess whether such investment is financially favorable or not. In the shareholder's perspective, whether such investment will help you to grow your business or earn reasonable return on the equity or reasonable return on the capital you have invested. That is the main objective of evaluating this. When you're going to evaluate this option, you can use several options like payback period, discounted payback period, NPV, because which is the regularly used method, net present value calculation, ARR, IRR, and profitability index. And remember these things which we have already learned, but you have to recall the things you have learned and how those concepts being applied in the final examination. That is very important. Therefore, capital budgeting is one of the critical topic. Okay. Payback period. There might be some questions they ask to calculate. Now, assume project will last only 5 years. Your payback period, did you decide payback period is 4 years? You need to evaluate that whether your payback period will be less than or equal to 4 years based on the requirement. Because as I said, you can see the past papers. In 2017, I can remember 2017 June it was tested. Therefore, you have to have an idea about how to deal with that. Therefore, how to identify the relevant cash flows and how to identify relevant cash flows and how to calculate the net cash flows generated from the operations. And how are you going to deal with payback period? That is very important. In payback period evaluation, it's always looking at the lowest payback period. Why? If you can recover the initial investment immediately, that means you are like a risk-averse investor. You are willing to recover your initial investment as much as possible. This particular evaluation technique is suitable when there's a highly volatile environment is there or high sometimes political uncertainty, economic uncertainty, high economic uncertainties exist. Under such situation, payback period might suitable. It can be pay normal payback period, it can be discounted payback period. Therefore, you are trying to recover your initial investment immediately as soon as possible. Net present value technique, as I said, this is the mostly used technique in PV. I am telling that if you look at about the past examination papers, if I say 5 out of sorry, 3 out of 5 NPV is there, NPV based calculation. If you can see how they have been tested and how it has been the way they have tested in the financial management aspect. You have to do the evaluation, thereafter you have recommended suitable financing strategy. Accounting rate of return, I have rarely seen the ARR, but you have that is return on investment, return on capital employed, and I haven't seen anywhere else it has been tested. But better to get an idea how to deal with that. IRR, yes, IRR technique will be tested when evaluating a project. NPV is one criteria, and you need to decide what is the maximum cost of capital that you can borrow. Right, there might be some options available, debt, equity. Then when you are going for borrowings or when you are evaluating, you have to see at which rate the NPV will be zero. That means up to which extent you can leverage your company. Right. Therefore, internal rate of return will be important to determine the maximum cost of capital which entity can borrow. Based on that, they can decide what sort of financing arrangement will be required and suitable. That is very important. When evaluating a project, most of the scenario I have seen, NPV and IR will be presented, and based on that, you can make a decision. That is very important. Profitability index, that's a kind of calculation that we simply calculate when the investments are uneven, unequal, then you have to work out based on the profitability index. The highest PI ratio will be given priority. Those are the techniques available, and we should more concern on. I am just glanced through the required area, right? This is not the whole thing. You have to work more. Then you can get a clear idea how to deal with this situation. That is very important. Then if I move to the next slide, use of terminal value, some concept I need to highlight. In your examination, generally the implicit period of calculation of forecasting might have been given for 5 years. Beyond that, the examiner might say the cash flows will grow at 3% per annum over next beyond 5 years. Then you have to calculate what is the present value beyond 5 years. That is explicit period. During the first 5 years, you will year by year you will calculate. Then you have to evaluate what is the value after 5 years. Generally, the other period. Then you have to calculate terminal value. In that terminal value, you can determine the cash flows, the present value of the cash flows beyond the given implicit period. Therefore, this is the way to do that. Sometimes examiner may not say it directly, but you have to calculate it. I'll tell an example. Now you are going to acquire a business. They have given the 5-year forecast budgeted budgeted income statement cash flow. So they have given the forecast for 5 years. You will work out 5 years. You can't say that business only lasts for 5 years. It may longer last more than 5 years. Beyond 5 years, it is an further estimation. You will take the cash flows and look at some growth if available over past 5 years. And based on that, you can predict the value beyond 5 years. Then you should discount those cash flows into the present terms, and then you can determine the entire business value. Otherwise, it will be incomplete, because because we can't assume that business will only last for 5 years, but it can long lasting more than 5 years. Therefore, then under such circumstances, you have to calculate terminal value. I can remember in 2019 June paper, similar kind of illustration was there. You can do it and see it and check whether you can tackle those questions. Right now, we are in a preparation of final examination. It's very you need to allocate much time. If you have a friend, you can have a chat and continue a discussion. That will be encouraged, not gossip, but you have to be encouraged for the discussion of the questions ongoing. Right, that is very important. This is just a glance through. I'm telling you again, this is just a glance through. You have to work very hard on the other aspect. This is just if I say, once I have completed, I will say how much weight you can keep it on the session today, but I am giving the background. Thereafter, you have to prepare. Then this is how we will how we can calculate the terminal value. You can use this dividend growth model to estimate this terminal value, because you might be familiar with dividend growth model, and free cash flow into 1 plus G into weighted average cost of capital minus G. That means why I have taken weighted average cost of capital. If that particular investment is financed by debt and equity, you have to calculate WACC. Otherwise, you can take either, if you 100% debt, you have to take debt ratio or debt cost of debt. If it is equity, you have to take cost of equity, right? That's if it is a combination, then you have to take WACC, right? Then financing strategy. Once you have dealt with then you have recommend what kind of financing strategy is required, right? Now, if we have looked at financing strategies, mainly you have two: equity and debt. Equity and debt. If you have not listed, you can go ahead with private equity, or you can go to a IPO. Now, in this particular company, it has been already listed in Colombo Stock Exchange. Then if they want to raise fund, they can't, now you can't be an IPO, no? Then you have to do some right issues and collect funds. That's the way. That is therefore equity funding, and the other one is the debt financing. Obtain bank borrowing, debentures, you can issue digital debentures and other debt instruments such as commercial papers. Because in debt funding, when there's a highly volatile environment, I'm telling you, in a highly volatile environment, debt financing may not be much safer mode of financing. Because if market is highly volatile and if your profit is highly volatile, then there's a serious effect on your debt repayment. Therefore, if it is a volatile environment, you should think about avoid debt financing a little bit and take more financing on equity. While looking at the scenario as well, you can see that. Right, okay. Hope you have understood that concept. Cost of capital, that is very important. Cost of equity and cost of debt. Generally, cost of equity considered as the highest cost of capital rate. Why? Because they will entitle for the residual interest. Then here we have discussed about cost of capital has three elements. One is risk-free rate of return. There are some, if you are invested in a government instrument, they are risk-free. Premium for business risk, right? When you are entering into the business carries some risk. Due to increase such risks, investor wants some premium to bear such risk. That is what we call premium business risk. Then financial risk, that depend on the mode of financial leverage. If you have highly leverage, your financial risk premium will be much higher. If you are low leveraged, your financial premium for financial risk will be lower. Depending on the capital structure, you can determine what sort of premium to be added to the cost of capital. All three will be considered when determining the cost of capital, right? Okay. Then we will move to the next one. Capital asset pricing model, which generally we will use to estimate the cost of equity. This is the mode of calculation of systematic risk based on the market which we are operating. You can see risk-free rate plus beta is the systematic risk or market risk particular to this particular entity. Then you have to multiply it from risk premium. This model will help us to determine cost of equity. Remember, beta refers the systematic risk based on the historical information, not the future information, based on historical information. In the pre-scene also, beta and market price also being provided, we can get an idea what kind of company they are, and we can get an idea how investors' perception on the company. Okay. You can look at the CAPM is mainly concerned with how systematic risk is measured and how systematic risk affect to require rate of return and prices. Okay, you have given a small illustration to avoid the session being boring. You can work out and let me know what should be the value for here. Let me know the value. Can someone give me an answer in the chat? Yes. Okay, thank you. It's 13%. 13. Thank you, Mapas. Right. Thank you. Thank you, everyone. How we have obtained the 13%, I will show it to you. If you substitute the equation, cost of equity equal risk-free rate plus beta into market return minus risk-free rate, right? Then if you look at about the risk-free rate, it is 4%. Plus beta is 1.5 times. 1.5 times mean we have to take 50% more return than the market. Always market risk considers 1. If we take risk more than the market, then your beta factor will be higher than market risk. Market return expected to be 10% minus market risk-free rate is 4%. If you work out, the answer will be 13%. That's how it looks like. Right? That's how it looks like. Right. Then geared and ungeared beta. The geared and ungeared beta, this particular way, we call geared beta as geared or levered beta as equity beta. It look at about the operational, financial, and operational risk present in geared beta. Unlevered beta we call asset beta, right? Asset beta is the riskiness or allocated to the asset owned by the entity. In unlevered beta or asset beta, you can evaluate that the risk in firm, it determines type of business when it operates, right? Therefore, there might be some situation you might have been given because based on the capital structure, the geared value of geared beta will be different, right? Therefore, unlevered beta determines the type of business in which it operates and its operating leverage. That is only considered about the operating leverage. It has not counted the effect on financial leverage. Effect on finance leverage depend on the debt to equity ratio, right? Therefore, when we are going to evaluate if you have financed through equity and debt both, then you have to work out what is the geared beta or levered beta. Therefore, this is the way to work it out. And you have sometimes will be situation which they provide the ungeared beta, that means unlevered beta. Then you have to re-gear it and calculate levered beta. That we have to do. Right. That depend on the geared beta depend on the operating risk, operational risk, as well as the capital structure risk from the capital structure. When if you have borrowed more and less equity, your financial leverage is much high. Then your geared beta will be much higher than ungeared beta. That's how it will work. In here, I am highlighting some most important ratios which you need to look at. Sometimes profitability ratios, based on the given information, also you can work out this ratio with, because this ratio you can determine whether the operation is generating sufficient profit or is it reasonable return compared to the market dynamics, right? Okay. Then you can see whether what has happened, whether my operating profit margin is increasing or decreasing. Then you can see some implication. If it is being continuously decreasing, what might be the reason? Then you can evaluate GP, net profit margin, sometime return on capital employed. Likewise, you can evaluate the profitability ratio of the company to get a clear idea of the current operation, right? Okay. These are some important ratios which you can go through. ROCE, profit margin, GP margin. Then DuPont model, you can get an idea, some situation based on the information available, ROI may not be able to calculate. Based on this, but you have this information, then you can work out return on investment, or sometimes return on investment, you can calculate your cost of capital by using this DuPont model. To get an idea, just I have included if the information is not being provided. But in this scenario, some of the information are available. Hence, you need not to go ahead with this one. But this information are available, you can calculate ROI as well. But while looking at the financial information, those given information, yes, I will share with you, don't worry. Available information, the given information are extract information, not the complete financial information. Even current asset, they are extracts. They are not the full balance sheet or not full profit or loss statement. Extracted financial information being given. Right. This is very important. Gearing, debt, and gearing ratio, debt to equity ratio. Sometimes there are different ways to calculate it. There are some way to calculate debt total debt to equity ratio. You will take current and non-current liabilities divided by total assets, right? Then debt to equity ratio, when we are going to calculate, you will take interest bearing net debts. Under such situation, trade payables will, those are coming under working capital, they will be excluded. Then it will be compared with shareholders' funds. If it is greater than 100%, it is high, right? They're high geared. That means you have borrowed more than your equity. That means significant portion of capital being contributed by debt holders. If it is an uprising market, if it is a high gaining market, that may be suitable. But if it is highly volatile and there are so many collapse or downward trends available, then higher leverage ratio may not be suitable. Therefore, debt to equity ratio you can calculate. Generally, we'll calculate debt to equity ratio while considering interest bearing net debts divided by shareholders' funds. Interest bearing net debts. Then here given interest coverage, because your operation should be able to pay you interest from the day-to-day operational activities. The operation should result sufficient interest to pay, sufficient profit to pay the interest. If you have go through the information, you can evaluate your one as well. What is the interest coverage for LPH as well? Okay. Therefore, in this particular ratio, the gearing ratio will be much important when you are commenting on the suitable financing strategy. Why we should go ahead with equity financing or debt financing, we have to comment. Based on that, you can decide whether current gearing high geared or low geared, whether you should further gearing the company or not. That is very important. Okay. Then next one I will move. Liquidity ratios. When you are running a business, it is very important to have working capital. The healthy working capital will help to continue the business with the disruption, without disruption. When liquidity ratios, these liquidity ratios will fall if you continuously earning some losses, then you will feel the issues. Your cash operating cycle is lengthier and you can't service the loan, then so many issues will come, right? Now, in a giant hospital in Sri Lanka also, they also face some liquidity crisis. You can see some information in the annual reports and you can assess their liquidity position, right? If you don't have sufficient funds or capital to run the business, it will have a great impact on your sustainability. Because it is very important to have sustainable financing in order to run the operation. Then if your current ratio has fallen and quick ratio has fallen, then it is a great impact. Therefore, these liquidity ratios you can work out based on information available. With the current ratio, quick ratio, you can calculate and see what is the current trend. Okay, when we are discussing the ratio analysis, I will explain one by one each ratio, what it means. For the moment, you can keep this as an uh, 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 keep this information as to get an idea how to perform the ratio analysis, right? Investor ratios, investors are more attractive to compare shares if they have been given dividends and they can evaluate how attractive this share is, right? Because dividend per share market price, then you can, if this is a reasonable return, they will invest on the company. If company has not paid any dividend, in LPH case is same. If company has not paid a dividend, definitely those shares won't be attracted. Then it become a great issue, right? Earning per share, you can work out what is the earning per share because number of shares also being given, and you can work out whether earning per share has improved and whether company is performing well, and market price also given, and market yield, earning yield. You can calculate price earning ratio. Then you can evaluate in investor point of view whether you look at the particular investment of a company is financially reasonable or not. You can make it. You can evaluate that one. In order to make such evaluation, these ratios will be much important. You have to keep in mind. Right. Most of the scenario we have to do business valuation. Therefore, the different modes are available and different way we can do the evaluation. Then we have to select what is the best way to evaluate the valuation. There are some information will be given in the pre-seen and in the information will be received in the unseen as well. Then you need to decide which mode of uh, valuation is required. Which mode of valuation is required. Therefore, net asset based valuation is one. Price earning based valuation based on PE ratio based valuation you can do. Dividend based valuation, that dividend growth model you can use to evaluate that one. And cash flow based valuation, that is you can use NPV, free cash flow basis based valuation you can use to evaluate a business. Those are 4 types of methods to evaluate or appraise the business. What is the value of the business? You can make some estimate or adjustment or evaluation. It may require when some situation when you're going to acquire another company, you have to evaluate whether what is the proceed, what is the offer you should offer, what is the price you should offer in order to acquire the stake of another company. Then you have to value what kind of basis, what is the minimum price to be paid, what is the maximum price I can go. Therefore, these valuation techniques will help and they have different characteristics. Some are suitable, some are not suitable. We have to see what kind of valuation method will be required, right? Okay, we'll look at net asset basis valuation. Give me a second. Right. Remember, net asset basis valuation, we will look at about the historical earnings of the company. We will look at current market value of the company based on mainly this net asset basis valuation, mainly suitable for a company who has more tangible assets. Their entire value is depend on tangible asset, then you can value the entire operation, entire business by using net asset basis. But there are some companies, they run at low capital assets, and if it is a service industry, then you may not be able to assess the value of business by using net asset basis. There are other factors also affecting the value of the business. If you value based on net asset basis, assume if the company has generated some serious losses of a few years, your net asset portion might have been diluted, right? Okay, but we have not considered what are the potential earning potentials of the company. This aspect will create the misleading information about the misleading information for making a decision, making a better decision. But you can make a calculation, and this will be the threshold value, minimum value based on the net present value, net asset value. There are some internally generated intangible assets will exclude when valuing the net asset of the company. That's why I said that most of the time, when valuing the company, you will calculate what is the value of the company based on the tangible assets. Then whatever the proceed which you have paid over the net asset value will be considered as a goodwill. That's how it will work. So for net asset based valuation also you can do it. You can calculate. Now in the given scenario also you can work out what is the net asset value per share for LPH as well, and whether it in line with the market price. You can compare and see whether it is okay, whether it is tallied, and is it a suitable way to value the company. You can do that, right? Okay. Yes, book value per share means net asset per share. Yes, NAV. NAV based valuation, net asset based value, net. Yes, book value per share, NAV. Then earning based valuation, because the previous scenario, it was not considered the earning potentials. Earnings have not been considered, right? Most of the scenario, this earning based and PE based valuation will be used as a basis to value business. But there are some pros and cons when valuing this particular method as well. Because we will use this earning per share, it's a historical basis, not the prospect. Future prospect won't reflect. It only reflect the previous earning which you have earned earlier, right? Therefore, this method will provide a value, but it might be inaccurate. But if you consider future prospect of future earning per share, then it will help you to decide if, earning value of the company little more accurate way, right? Right. So again, the dividend growth model, I think you have already learned this one. That's why I said that when you are going to calculate free cash flow basis valuation, also the same model we can apply to determine the value of a share. You can see D0 is the today's value, what is the dividend received recently, and 1 plus G is the growth rate. Then divide by cost of equity minus growth rate, then you can easily work out the price of a share, right? Over the period, you have to accumulate the value. Then we can easily work it out, what is the price of a share, right? Because this particular basis also will be applicable, same model will be applicable to determine the value of a business based on free cash flow. Free cash flows, you can see how to determine the free cash flow. Revenue, operating cost you will be added, and you should add depreciation because debt repayment and lease obligation, working capital increases, taxes, replacement of capital expenditure, you have to deduct when determining the free cash flows. When it comes to discounted cash flow or NPV calculation, under such situation, you should not deduct. This is free cash flow basis evaluation. When we are going to do the NPV calculation, since we are discounting it, if we have the discounted cash flow, then you should not consider about interest reduction of interest again. The prepayment should not be considered. If it is an appraisal, like a project appraisal, because the prepayments, initial cash outflow will be taken at the inception. Then if you consider the debt prepayment again, then it will be duplicated. Right. If there's no investment and if you have already obtained some loans, if you have current operating costs, you can deduct. Right. After that, I need to cover up some risk management aspect, which will be helpful for you. The one of important risk aspect after considering the financial evaluation, those areas, those risk calculation, ratio analysis, valuation techniques, you should have an idea about that. And based on those valuation techniques, you can derive the value of the business or value of the proposal you can derive, right? Uh, then you have to look at about the risk management aspect as well. What kind of risk prevail in the market? What kind of risk relevant for the industry? Number one for a business is the strategic risk. The decision what you take today will make a huge impact on the growth of the business and growth of the cash flows, and the volatility of the cash flows will be affected based on the decision you make, right? Therefore, you in a strategic decision, strategic risk means the risk arising from when you're going to make a strategic decision. Sometimes it might be right, it might be wrong. If it is gone wrong, what is the impact? That is the risk that you associate with the decision what you are going to make. Can be accurate, it can be wrong decision. Therefore, that is the risk which you carry out about the strategic risk. The decision, okay, I will take an example. The decision government is decided to take ban chemical fertilizer. That is a strategic decision. Due to such decision, what are the repercussions? It has a huge impact to the economy. Crop yield has fallen. We had to import rice even due to that import ban, and we have lost the yield of the commercial crops as well, right? Therefore, that caused a serious issue on the country's economic situation as well. That we can see that is a strategic risk. The decision you have taken when you're going to make a strategic decision, you have to evaluate all possible aspects. Based on that, you need to make the decision. Clear? Hope you have understood. You can see the choice of suitable strategy has a significant risk for the future operation of the company, of the group, right? In this particular company, they are operating as a group of companies. Then when they run the operation as a group of company, there's a high risk. The decision what you make may create a serious effect on the profitability of the company, serious effect on future growth of the company's strategic decision. Then you have to identify such risk. While you are, if you have properly read, because I have already read 3 times in the pre-scene. At the moment, I think you have already read more than that. And before, after end of the month, I might have to, frankly, I have to read the entire pre-scene more than 5 times. because time when you read and when you have a chat, you can identify. Now there's a strategic risk. Can you remember there's a position, they have made an investment in a nursing school they have started, then it has created a significant distress in financial situation. That is kind of a strategic risk what they have made, and you have to evaluate. Therefore, strategic risk, as you now, during the crisis, I have not mentioned the name of the brand. Some confectionery manufacturers like biscuit manufacturers, they have artificially increased the price, right? Previously, which you have bought at 50 rupee, went up to 200 rupee. What was the reaction? What was the reaction from the customer? Customers didn't purchase. Then subsequently, what they had to, their sales were dropped significantly, because that due to that decision, they have lost their market, they have lost their sales. Therefore, remember, those strategic decisions may cast a huge impact on companies' image, companies' operations, and the growth of the company as a whole. That is very important. When the people who are making strategic decision should be well aware about the risk they are carrying on the decision making. That is very important. Operational risk. All right. While reading pre-scene, you might have seen different operational risks. Because when you run the operation, there can be risk associated with the operation. Now, these are some examples which you can identify, which you can get an idea about the kind of operational risk. Losses from internal control system or audit inadequacies. If you have not proper internal audit procedure, if you have not proper checking and controls, there can be serious losses, right? There might be failures in operations. In LPH also, if they have not properly developed an internal control systems, and if they are not following it, then there's a serious issue they will have to face, right? Non-compliance with regulation or internal procedures, I have said that. It was there actually. Non-compliance to internal procedures and compliances. This is very serious. In the hospital industry, when it comes to there, if you have not complied with certain rules and regulation and standard practice, then it will create a bad image, and it will sometimes your license will be cancelled. That is very serious. That's why, because in the hospital industry, we are operating in a highly regulated industry. That you need to keep in mind, highly regulated industry. Therefore, non-compliance will be a serious risk which you need to consider. Failures and inefficiency with information technology systems, but you can evaluate in the company's point of view whether they have properly using their technology. Are there any failures and why such failures has happened? You have to evaluate. As an example, now you are taking information, electronic medical reports, EMR. If you're taking electronic medical reports, okay, if those information released to public without your knowledge, right, if data breach has happened, there's a serious issue with you. Sometimes business interruptions will be there. When you're running a company, you have to, if there's no sufficient supplies for medicines or drugs or vaccines, then you will face a serious issue and the operation will be interrupted. Loss of key employees and human errors. If the particular LPH key resource is human resource, if you lose those human resource, definitely the quality and the service or accreditation won't be there. Because since professionals are there, or people or talented employees are there, then saving, they surviving. That is very important. These days, they might face serious issue when retaining people because most of the people or doctors are uh, already flew outside the country. That is the reason. There are some doctors, they are yet to obtain the visas and leave this country. That is a pathetic situation. Even in the current situation, most of our young card accountant also, they are planning, my majority have left and some are leaving the country because yesterday I have witnessed in the election also in membership number around 6,000 to 7,000, those queues were, there's no queues for that actually. There's no hassle, only few members, but member numbers around 3,000, 4,000, they were had the queue. That means those people still there, but the people who have recently qualified, they have left. That's loss of human, loss of key employees will be a huge impact on the quality of service and business continuity as well. That you need to keep in mind. If you want to give a quality service, you have to have the quality people or talented and professionals to be there. Otherwise, operations quality will dilute and it has a bad impact. That you need to keep in mind. Damage of reputation as a result of operation failure. Yes, you have seen some surgeries have created some issue. Therefore, those operational risk is there. Therefore, you have to look at that one. Then, if you operationally the procedure is not followed up, then it may create a serious issues like that. Because legal action being taken by the victims, and it has created a bad image of the hospital. That you need to keep in mind. Use of outdated technology, right? Because time to time, the new technology will come into play. If you are not updated accordingly, then what will happen? Because I was seeing use of modern technology. Now people have ChatGPT. Now it is a older version now. Now new mode of AI use techniques are there. Now we have discussed about industry 4.0 technologies. Now it goes to industry 5.0 technologies as well. Right. Therefore, we have to embrace new technology. Otherwise, we become obsolete. You can remember when it comes to this operational technology obsolescence. I'll give an example. Those days when we are having wanted to take a medical report mean plasma blood report. You have to give the blood, and thereafter you have to physically visit there and you have to take the medical report. Now it's not like that. Once you have given your blood, then once the report is ready, you will receive a notification to mobile, and you can go to the mobile and you can view the report from your mobile itself. Right. There are so many ways now. New technologies being evolving, and digital health records also being taken, and those kind of new technologies will be useful in the future. That you need to keep in mind. The technological obsolescence may create a huge risk to the company. That is what we need to look at. Financial risk. In the financial risk, spread into different subcategory. One is financing risk. In the finance risk mean if you have already utilized whatever the facilities available with you, then you may not have sufficient or there's no sufficient way to raise the capital. There's no mode of raising finance. The existing facilities being already utilized, or the lenders are not willing to give some funds, or this will result serious effect on the liquidity. There will be serious disruption to the operation as well. If you have fully utilized the available funding, and most of the funding, even though you have utilized, assume if you have utilized, you have a significant portion of short-term financing and you have utilized most of short-term financing. Now you have to settle them. Then there's a huge pressure due to the cash flow shortages that can happen. Therefore, financing risk plays a vital role in the risk management. Financing risk. Then liquidity risk. If you don't have liquidity position, you have to see whether current ratio, quick ratio, and see whether company can operate. Sometimes there might be net current liability situation as well. If there is a net current liability situation, that means current assets are lower than current liability, simply you are insolvent, right? If you don't have sufficient capital, if you are running at net capital, current liability situation, what will happen? Your operation will disrupt due to non-availability of working capital. That you need to work out, that we need to manage ourselves. Cash flow risk, that means cash flow risk mean you expected to receive some cash on some specific days, but it may be delayed. Under such situation, you may face cash flow risk. Assume you have planned to settle the creditors after 40 days and you expect to collect debtors within 35 days. But if the debtor has not been settled, then you will face a serious issue to settle the creditors. Therefore, variability of cash flow will create a risk when running the business. That we need to keep in mind. Then credit risk, actually this credit risk, if it's a trading company, if you sell on credit, then you might have faced some issues of recovery. But this is a part of risk. I don't think so it is much applicable in this scenario, but you have to keep in mind, if you sell on credit, okay, or when it is due, sometimes you may not receive it, sometimes they might be defaulted, right? Therefore, continuous credit risk monitoring is required. That is a kind of a idea which you need to keep in your mind, you need to keep in your back of your head. And credit risk mainly lie if the counterparty or customer fails to the contractual obligation. Assume if you have invested in commercial papers like that, if the party is not capable, or doesn't have any capacity to pay interest and capital, then you have a credit risk, right? If it is past due more than 30 days, you have to assess it has a credit due amount. There will be market risk. That means interest rate changes will be there. Other one is exchange rate changes. Both will affect. If you have borrowed recently, interest rate movements will affect adversely to your financing cost. The reduction in interest rate favorably affect your financial performance of the company. Now we are in a phase of which interest rates are declining. If interest rates are declining, you can save some cost. Okay. Then exchange rate risk at the moment. What is the current dollar rate? Can someone give me the answer? What is the current dollar rate? 327, 330, 331. Yeah, it's average around 329 to 331. Right. And if it is float again to 400, what will happen? All the cost associated with the imported item will rise. Right. Therefore, that may cause a serious effect. the exchange rate movement will affect, because some of the medicines we have to import, or sometimes you have to take it from agent has to import those items. But when the exchange rate if high, the cost will be double. Right, that we need to keep in mind. Right, now we are moving to Life Plus Hospital PLC. Little bit faster. I want to finish it quickly. Then you can leisurely go through this. Just I have done rough explanation about how it will impact how financial management looks like. Here on onwards, I will give some implications, some area relevant to the given information, and I will comment on this. Then you have a lot to do. The complete understanding and evaluation or further workout is lying with you. Right. Life Plus Hospital PLC, since you have gone through with the pre-scene already, I will see if there's some implications are there. I will highlight. Thereafter, you can work out on it. Right. Background, if we discuss about the Life Plus PLC, Life Plus Health PLC, they are part of a group conglomerate. They're in a capital goods market, and they have investment management company and Life Plus Hospital PLC, that is the LPH. In the previous examination, we might have received 2-3 companies which they are in 3 different industries. But this time we have Life Plus Hospital PLC, no any other companies to worry about. Right. This particular company, Life Plus Group, founded by Stephen Nanayakar. Life Plus Medicare began as a consultation medical center. That means almost 43 years ago, 1980. Right. The company went public in 2001, offering 30% of its equity. That means public floating there is 30%. That balance is not public floating. It's equity. LP is committed to service, quality, compassion, affordability, and innovation with a focus on holistic healthcare solution. Who is the current chairman? Current chairman is Eden Nanayakar, and throughout the discussion, you can see how he has behaved and what are the implications over that. While reading the information in the pre-scene, what I have noticed that Dr. Eden Nanayakar, kind of an executive chairman, and he's dominant in the board, and he's always involved in the operational activities as well, with which need to be cared by CEO. But while reading the pre-scene, you might have understood it, that you need to keep in mind. Then I have a highlight. I wanted to comment on some key ratios, what it means, and then how I'm going to comment on the given information. If you look at about GP margin ratio, mainly your total revenue lie with the service fee income, sometimes hospital service, laboratory service, and all other patient-related service. And the cost, most of the cost items are related to your consultation fees and equipment. Those costs are part of a significant cost component. If the GP ratio is, if your operations are efficient, right? If your operations are efficient, you can have a good GP ratio. And you can compare it with your competitors as well. In LPH, if they can calculate GP ratio, and they can compare it with competitors, because publicly available information already there. It is very easy to compare it and see whether the given GP ratio is sufficient and what has happened, what are the things we need to do. Because in your examination, you have to evaluate what are the implications and how are you going to deal with such situation. That is very important. A higher GP ratio indicates better efficiency in managing cost and generating profit from patient services. Higher GP, that simply it is higher GP is there. That means you are managing your operation very well, and you can run your operation effectively. That's why your GP margin is higher. You have to see how LPH has performed. What has happened to that GP, we will see later. Then I have taken operating profit margin ratio because in this scenario, the information which examine pre-scene has been provided only contain operating profit, and it has not considered taxation or any other thing. Taxation was not being considered. Therefore, I have considered this operating profit margin ratio, whether you have, when you run the operation, whether operation runs smoothly or not, you have to evaluate, right? Primary cost plus all other service cost, you have to consider all other resources you have to allocate it, and you have to calculate net profit margin ratio, right? Then you can evaluate and how the company perform and how industry works, whether they are sufficient or whether the given pattern is similar to the industry or not. You can get an idea. Return on equity, because capital holders wanted to know how much return they can get if they invest 1 rupee. What is the return against that 1 rupee? Return on equity. In order to retain or for the investment in equity, they need to have a reasonable return on equity, right? Without proper ROE, they might think to, right, this is not a viable investment. The return on investment, higher ROI generation mean the equity capital generates sufficient returns, reasonable return in the operation. Very important thing, because I have taken return on, not return on asset, return on equity. Equity is readily available rather total asset, because it is the other information I extract. But very important, when you calculate ROE, better you can compare it with the industry average. Then you can get a clear idea. Debt to equity ratio, as I said earlier, you have to evaluate whether the company is highly leveraged or not, what kind of source of financing will be available in future, that you can evaluate and see whether the company is highly leveraged or not. Okay, if you have a lower debt to equity ratio, mean you are very conservative, you are not willing to take much risk. If it is higher, if it is greater, then you are willing to take higher risk, right? That means if you are willing to take a higher risk, then your debt ratio, bank borrowing will go up, and debt to equity ratio will go up, because debt divided by equity. If you borrow more, and your debt will go up, and your debt to equity ratio will increase. If it is decreased, definitely it is risk averse investor, and he applying conservative approach. Then interest coverage ratio, times which you can pay your interest from the cash flow generated from your profit generated from the operating activities without any depreciation, and from running an operation, how much it has generated, and how many times you can serve your interest cost. Then if you have a sufficient interest coverage, that means you are healthy. You can, as an example, if interest coverage is 1 times, that means the available operating profit entirely goes to payment of interest. If it is greater, that means you have a lever way to earn some profits, right? Therefore, it is better to look at interest cover ratio. Investors and traders use the interest coverage ratio to assess the risk associated with the company's debt and its ability to handle debt-related challenges. That is very important about interest coverage ratio. Current ratio, we have learned, generally current ratio look at about the liquidity position. if you have your liquid current ratio has fallen, definitely your liquidity crisis will arise. You have to face liquidity crisis. These are some ratios which just I have worked it out to get an idea. Basic financial ratios of LPH. You can see the GP ratio, what has happened, 47, now close to 39.24%. It has declined in a highly volatile environment. Now your GP ratio is continuously reducing. It may has an impact. If you look at about operating profit margin in 2020 and 2026, it was negative, and that means your operating profit, it's an operational loss resulted in 2020 and 2021. But there's a bounce back. In 2022, you can see operating profit margin 19.69 negative went up to 4.8%. Right. Again, it has gone marginally by 0.61. But remember, that is not sufficient. That means there's a serious volatility in the arrangement. Serious volatility. Look at this one, William. It has reduced. It has declined. Right. It has declined. But operating profit margin is a very minimal amount. And if you look at the return on equity, 1.41 is a minus. Again, it came back to 7.161. Again, it is less than 1%. Debt to equity ratio, you can see 18.33. I have considered only interest-bearing borrowings. I have excluded gratuity or retirement benefit obligation and trade payables. And if you calculate debt to equity ratio, debt composition is going up. When a company in a downward situation, borrowing from a bank or debt financing is not suitable, it may create high pressure on the business, right? Otherwise, if it is a not volatile environment, if it is a good stable condition, then you can go to, if your market is growing, your profit are increasing, then you can go ahead with debt. But by looking at the given information, operating profit, GP, ROE, all have been reduced. That is the serious issue what I need to highlight. Therefore, when we are going to evaluate their liquidity debt equity ratio, they have tend to borrow more. That means if they generate losses, they have to borrow more funds. That we need to keep in mind. And interest coverage, very importantly, look at this one. 2020 is more, almost barely it meets the requirement, 0.38. And here, 0.38 is not enough, right? And here it is minus, even minus 10.32. Except 22, 23, and 2019, all other are not. Right, okay. Oh. Current ratio also, you can see current ratio also deteriorated. And quick ratio also fallen. In a hospital, like you can't exclude the I'll take operating profit. Take operating profit. Can we have the PPT after this meeting? Yes, give me a second. While having the session, I will share. Is it okay to if I share in the chat itself? Immediately after the session, I will share in the chat. Don't worry. Then current ratio and quick ratio, you can see it is declining. If you look at about over the period, whether performance are improving, no, it is performance are getting declined. Therefore, you have to much pay attention on the performance declining. When the performance are declining, you have to suggest how to improve the performance and how to turn around the current way of operation because it is going down. You might have seen so many operational issues while reading the pre-scene, and you have to highlight those are the reason behind these lapses. That's why they have been fall behind. Therefore, those operational issues need to be sorted out. Otherwise, if it is continued, probably in near future, they may not be able to run the operation. Right, okay. There is simple glance about the ratios and you can further analyze. And importantly, what we can do if this kind of situation are there, what kind of actions to be taken and that need to be discussed your own and what kind of things you can do. You have to think because you are a final level student. You have to think about what can we do to turn around the situation, right? Which while I'm reading the briefing, I wanted to highlight one particular area because remember this is even less than 1 or 2% of the total analysis which required. I'm just giving the brief introduction. What I was seeing in the financial distress section, which highlighted they have started a Life Plus nursing school in 2017 and incurred substantial losses that affected to the serious losses affected to continuous investments and it has affected relate their capital investment that might cause a serious issue, right? While discussing, they said that they have anticipated they they were not anticipated to generate profit. At least they're supposed to operate in a break even, but it is not they are generating serious losses. Then you have to see and how to restructure the operation because it directly affected to the growth capacity of the hospital, right? Heads of executive team asked for the cost reduction strategy. What kind of cost that can be reduced, they have to evaluate, right? While reading the illustration of pre-scene, one HR manager, there's Ken Migar, I think, Ken Migar, he says that we are overstaffed. Then we need to give some laid off. We have laid off some employees. Remember, when they are recruiting, they have to assess what is the real staff requirement. Otherwise, this embarrassing situation won't affect. And while reading the situation, I can remember they have laid off some employees without further notification. Give me a second. All right. Liquidity position has deteriorated over past years. You have seen that, and employees were demotivated with immediate laid off some of employees because without any prior notice, assume your subordinates are being sacked. Then you will get disappointed and you will be demotivated, and you also feel some issues with your job security. Then you might think about that. And your motivation will not be there. You will always think about your job security at any given point of time to feel that I will lose my job. Then that effect may create a serious effect on the quality of the service. And very important thing, liquidity has fallen, their leverage has increased even during the volatility situation and loss-making situation, and that situation, this is a serious effect that we need to consider, because that is a highly unlikely that you will go with borrowings and all when the market is not performing well. When market is going down, then the profit are declining. Therefore, under such situation, equity should be the capital infusion. But they have borrowed and they have increased the leverage even in the underperforming period. There was some indication that they have not properly evaluated the decision before making, and there are some HR related issues also over there in the operation, and they have some conflict with the chief medical officer as well. You have to keep that in mind. These are some financial indication which given in the pre-scene. You can see the revenue have grown up, but in 2023 again it has been drop a little bit, but the escalation of cost you can see in 2022 and 2023 was significant with compared to 2021. The reason might be the increasing of revenue around 50%. And cost also increased by around same percentage, around 30%, around 30%. Then GP margin, you can see GP margin in 2022 and 2023, it compared to other period, it a little bit high in 2021 and 2020. But you can see in 2019, you have generated 9,492 million revenue and generate 4,556 as the gross profit. But now when we are doing around 12 billion, okay, 12,000 million revenue, but still gross profit is 4,645. Look at the revenue composition. In previous revenue composition, you had a serious significant proportion to hospital revenue. It remains same, but one thing has happened. What has happened? Your laboratory revenue has gone up, and in addition, your pharmacy revenue also went up. That means those revenue stream might not have a serious profit margin. Profit margin might have been reduced on pharmacy and laboratory revenue due to the competition, pharmacy revenue due to the government regulation on pricing. That you need to keep in mind. Right. Remember, these are not fully total assets and liability, because it says extract from a statement of financial position. If you add non-current asset and current asset, then you can't take the total asset because it won't be tallied with equity plus liabilities. It is not tallying. Therefore, we need to look at about some other ratios like what I have suggested now, return on equity without return on total asset, because total assets are not tallying. You can see the return on equity value has declined in 2021 and 2022. It has gone up again. It is kind of a marginal amount. You can see equity amount has only reduced by 2 million. Right. There's a significant amount in revaluation reserves, and return earning over the period, it has been little bit drawn down, like due to the losses resulted in between 2021 and 2020, especially from 2021. And if you look at about non-current liability, benefit obligation, retirement benefit, when you're calculating a debt to equity ratio, better we can remove this one as well, right? Because it is there's a provision what we make, better we can remove that one. Then historical data. while looking at monthly stock prices and quarterly beta and ASPI, this is 3-month treasury yield, you can see based on this particular company, quarterly beta on ASPI in Colombo Stock Exchange 2021, it was in 0.7. Right. Market price 149 or 100 above the price. Then gradually what has happened, you can see beta factor continuously grown up. Actually, if it is 0.99, is close to 1%, that is market. That is the market, par with market. If it is below 1 mean, it's very conservative. If market change, return change by 1%, the company return will be changed by 0.7%. Right. Likewise, it was there, but in 2023 onwards, you can see 2022, it started to growing up. In 2023, it went up further. You can see. Now it is 1.6. That means if it is investor willing to invest in this particular share, they have to take a higher risk. That depend on the market condition as well. When it is a bullish, we call bullish and bearish market, the share price also will affect because investors' perception will change. And you can decide, you can see 3-month treasury yield also given. Why this has been given? To get an idea about interest cost. There might be some indiscipline when they're borrowing funds in short term and they might have to pay a higher interest. If they have done an investment, they have to see about the yield, what they have taken. Then if their cost of funds is much greater than that, then they should not invest in. Right? But we will see when we are going to make a future investment, if it is equity funding, you have to look at about the market condition, what kind of rate you can borrow. But in some situation, they said that it is equity funding. Share price and market risk. That is, look at about the share price and market risk, which measured at beta. That is stocks or portfolio sensitive to market movements. Remember, if higher beta is there, that means investors have to bear a higher risk and higher return. When it is we call bear and bull market, it's a bull market, it's a market is increasing and your risk factor is very high, then there's an option, there's a situation you can earn a right. Then the market both up and down directions, right? In a bull market, high beta stocks may outperform, but they can also underperform in a bear market. Now, when you can see this one, now in the recent we can see a bearish market. In the bearish market, they will underperform. Their prices will go down. Then investors who have invested, they will lose significantly. No, now situation, now investors' point of view, they were willing to take a higher risk for this particular, but higher return they can expect when there's a bull market. Bull market mean a bullish market mean their market prices are going up. Market is performing well. Under such situation, if market is growing, can you remember the period where ASPI hit to 14,000 units? Then under such situation, the people who have invested in a high risk stocks, they have gained a higher margin. That is the capital gains. But it is a bullish bearish market. Bearish market means market is continuously going down. From 14,000, now it is 10,000. Further, it is going down and not much trading are going on. Then investors might lose, even because they have taken a higher risk and they will lose their money, right? That risk is there because high risk, high return. When market is going down, you have to get the higher losses as well. If it is a beta factor is below 1%, if the market underperform, there won't be less impact to those investors, right? That can happen. That is the impact of this beta factor and share market price. That is the relationship. Then the risk management aspect. Right. In the risk management aspect, I understand, identified few key risk areas, and see when you are going to evaluate what are the major key risks which you can identify. One is the clinical safety and quality of service, very important. Clinical safety, if when you are running a hospital, is very vital. Why it is vital? If you have done any errors in doing surgery or medical treatment, it will create a disastrous impact. Therefore, it is a vital one. Chairman and I will explain chairman and executive chairman. Clinical safety and quality of service, very important in a hospital. If assume 10, if the patient have been died, because there's a case also due to not a died or some malfunction or what, there's some case against the company, there was some accusation. It is very critical for a continued business continuity of the company. In a hospital industry, very important. Clinical safety and quality of service is very important for the survive in the industry. If you fail, if there's a huge risk, your operation will be sometimes suspended. Some government will be monitored your performance, activities, and sometimes they will cancel the license. Then next one, very important one, is skilled workforce. If you can't retain and recruit, reward the talented employee pool within the organization or hospital, you will lose. This is very important because high quality service won't be provided if you don't have high quality professionals here, professionals and workforce. That is very important. There's a serious issue. Doctors are now leaving the country due to the economic crisis and so many reasons. And that's why these existing doctors also might ask a premium price, or their prices or charges might be much higher. The other one is technological risk, because we are taking some information from the patients and we are making digital health records. Then if those information being leaked or revealed to the general public, it will cause damage. It is damage to your reputation and it will cause damage to your operational activities as well. Then market competition. There are so much of market competition. As you look, you have several market or product or services you are selling. Hospital and laboratory and pharmacy. Then laboratories, other competitive hospital also, they have island-wide laboratory services. Then we have a problem if you have failed to give a good service, and when there's a high competition, you have to offer the product or service at a lower price. Otherwise, you won't be able to sustain if the similar kind of services are available at a lower price. That will have an impact. Financial risk. If you don't have sustainable financing arrangement, then financial distress, okay, will create serious issue of the financial health. Now, if your liquidity position is deteriorating, if your gearing is improving, then if you are generating continuous losses, it will create a serious issue that you need to keep in mind, right? Okay, that is financial risk. Right. Just I have simply glanced through all possible areas which will be helpful for you to understand. And now it's your turn to raise some question if you have, and I have a little bit time. Yes, there's a question. So what's the difference between chairman and executive chairman? If it is executive, now CEO also can be appointed as the chairman of the company. Under such situation, he will be considered as executive chairman. Under such situation, we have to appoint senior independent non-executive director, and there are some governance requirements to be followed. Right. That's why generally most of the companies appoint independent non-executive chairman, director as the chairman to maintain unbiased opinion or to run the company without any biasness and discharge both responsibilities. That is the difference. Industry related ratios won't be tested because some information is bed occupancy and thing we have not been given, only check whatever available. Give me a second. I supposed to share that. You give me a second. I will share it now. I think I just shared the see whether you have received it. Just I have shared. Aruna, can you allow to share that one? I have shared in the give me a second. Give me a second. Give hi. Okay, wait. I can do this. Give me a second. I am sharing because I have shared the post. Now see whether you have received it. Right. Right, guys. Excel file passed this guy in the website. I will show you. Guys, you should be familiar with the website now. See Sri Lanka. Right. Give me a second. You can go to CA Sri Lanka website. Right, I'm sharing CA Sri Lanka website. Under student tab, go to examination. Student tab, then examination. Once you go there in the examination, if the XL5 integrated case study exam, right, then you have the pre-seen and unseen is there. Right. But I think this is not the time to get an idea. You can look at pre-seen and unseen. And suggested solution, if you want to see, go to suggested solution, then you can see these are suggested solution are there. Right. Here, suggested solution also there. You can watch it. Because you should be familiarized with the available material and you have to work out that. Now, this is not a good time to go through all the papers and all, but you can properly structure with us. Those information are there. Mm. No, 3 months treasury yield. Most of the government recently borrowings are mostly 3 months treasury yield. That means short-term earnings and short-term treasury bills. Bill market was very active. That's why short-term borrowing rate is given most of the time. Entities, not like uh, financing institution provide the loans at floating rates. You can get what is the return, risk-free return, average risk-free return, which you can expect. Because longer-term bonds not give a higher rate. It's a lower rate will be given. Now that is the opportunity because which you can consider risk-free rate in short-term investment, how it is still floated around. There are some information sometime you can go through that. That means there is the average return which you can expect over short-term investment. Most of the times, treasury bill and bond options are going. You can see what are the rates being offered in the treasury bills and bond options, and then you can get a clear idea about how it's going on. Yeah, I will show you the prices. You can see rates on government securities. You can see the market behavior about the interest rate movement. You take from this range. You can see most of the traded bonds, government instrument is treasury bills, and their rate movement you can see 3 months, 6 months, and 164. When it compared to the treasury bond yields, you can see they are a little bit lower compared to treasury bill rate. Then most of the people tend to invest in treasury bill because their rates are a little bit favorable than treasury bond rate. Most of them, as you are investor, your opportunity cost lie with the 91 days treasury bill. You can get a higher return compared to 182 or 364 or treasury bond rates. But the problem is the rates might highly fluctuate. This one. In each 3 months it is changing, each 6 months it is changing, each year it will be changing. But if you invested in a 5-year bond or 8-year bond at 13.56, it will receive over the period in the same rate. Therefore, you have to see now here 5-year bond traded at July at 15.74. If you have invested at that rate at that time, then even the low interest rate environment, you can get a higher return over that. That's how you can get an idea about the interest rate movement, and you can get an idea about these. Actually, they have been given. You can get an idea about their cost of capital and what sort of investment, the minimum return what you can expect, whether sufficient return being generated if they have invested in a treasury bill and bond in a risk-free investment. It also gives us a serious return. If you are unable to generate, means they are losing money. There's an opportunity cost. That way too you can interpret it. Right. Okay. Now, before winding up the session, because I just glanced through, because don't think this is the complete discussion, complete analysis of the paper, because just I have given you the background to study, and I have given you to get an idea of the which areas which you need to focus on. Since this is a final hurdle, don't take any chance or don't this particular situation, because this is the final examination and you need not to take a chance to fail the exam. You have to focus on your study, and you have to properly arrange your study. Most of the information related to the financial management will be given in unseen, and you have to prepare for that. Right. Anyway, finally, it's a great privilege to share some thoughts with you guys, and you have to work very hard and smart within next few days, next few weeks, actually, and then you can easily pass this exam if you give your right commitment and attend to the detail and don't confuse with unnecessary areas. Focus to the basic, then you can easily pass the examination. Then I would like to wish you all the best for your final examination, and definitely you will be able to pass this one, and hope I have had some value to your discussion, and better you can have your own discussions with your friends, and continuous discussion will help you to achieve the great success. Therefore, wish you all the best, and thank you for joining the session, and wish you all the best for your future, and see you soon in the next CA members conference as a members. Wish you all the best. Thank you.